Good evening, ladies and gentlemen. This is Rahul Magan from Treasury Consulting Group. Ladies and gentlemen, securitization is amongst the oldest and one of the largest financial market instruments in the world. History has witnessed that enough has been done in the securitization market, and even after that, lot to be done. But that is highly unfortunate that 2008 financial crisis was because of securitization. I'm not going to be raising this point in this video because enough has been said on the internet about 2008. Ladies and gentlemen, we are having so many instruments as far as the securitization is concerned. Please take a note of that. So if you're expecting I would be able to cover all the instruments, then I apologize upfront. But today, I would be talking a very serious issue in securitization market, and I would be linking this with what is happening across the globe. One of the finest instrument the securitization market ever been is called pass-through certificate, which is known as PTC, pass-through certificate. Pass-through certificate legislation means the norms, the valuation norms, the listing norms varies from country to country. Like I said many times that United States is considered one of the largest financial market in the world, and this is true. And United States is holding the largest securitization market in the world, that is also true. And the kind of instruments which are available to trade in United States is something which I haven't found anywhere in the world. Ladies and gentlemen, we need to understand that what is pass-through certificate and why it is mandatory. Often you find out that there are people who are non-banking financial corporations, home loans, they are giving vehicle loans, student loans, credit card loans, and all these kind of things to the respective people. What happened over the period of the time, they accumulate an asset base. Example, if you are giving a vehicle loan, you are taking some collateral into consideration. Over the period of the time, that collateral accumulates in your book. I'm not saying that you're not making the money, because if you're giving the vehicle loan, you are charging something from the customer, and that charge is obviously higher than the savings rate. Rather, it is sometimes much higher than the saving rates. It depends upon the income profile of that relevant person. But when the banks, who are also known as originator, non-banking financial corporations who are also known as originator, accumulates a huge amount of collateral, they wanted to release this collateral so that they can make something out of it. Now, how they're going to be doing this? Because one thing which we need to understand is that there are two resolutions to it. And like I said, it depends upon country to country, jurisdiction to jurisdiction, in that what kind of resolution the jurisdiction wishes to adopt. One resolution is that bank, probably non-banking financial corporation, from the same company, the company which is operating the business of lending and borrowing, issuing pass-through certificates. And when they issue pass-through certificates, they are actually inviting the investors to come and buy these pass-through certificates. It means that they are making this collateral as an asset base, and based upon that asset base, they are inviting the investors to come and subscribe these pass through certificates. Now, ladies and gentlemen, when I say investors, I mean to say there are only two ways investors can be invited. Number one, they can be invited via public. There are few jurisdictions in the world who are allowing securitized debt instruments, shortly known as SDI, securitized debt instrument, to be held by the normal retail public. There are few jurisdictions who completely ban the SDI for public. These jurisdictions believe that SDI is not for public, they are for sophisticated investors. Henceforth, we need to understand that in what kind of jurisdiction we are talking about. Take a note of that, because there is a very good line in English which is called state jacket formula. And the meaning of that straight jacket formula is that there cannot be one formula who fits in all the cases. There cannot be one formula. Okay. Similarly, ladies and gentlemen, we need to understand very clearly that second option is called private placement. It is said that pass-through certificates are often done using private placement. And to an extent, I agree without quoting any specific jurisdiction, but I strongly believe that there is one another way which is called roadshows. I have seen that there are various advertisements about the road shows in the public, on the Google, happening in the different global financial centers. And the sole purpose of the road show is to invite, is to promote your XYZ product, financial product, of course, to the investors. And the authorized agents on behalf of the investors will come and subscribe these products. Of course, their bosses have to approve. Henceforth, when it comes to securitized debt instrument, there are two ways. Number one is definitely the public participation. That depends in which jurisdiction you are residing and so on and so forth. And second, which is definitely the private placement. Investor community of pass-through certificates need to understand that the asset quality is the main issue. Because if you are an investor who is investing his or her hard-earned money in pass-through certificates, then one thing which is very much important is the asset quality. Because asset quality is known as the pool. Unfortunately, that is a technical term. Most of the people do not understand this technical term. Most of the people even do not understand that how to, not using a word investigate, that how to scrutinize a pool. Most of the people even do not understand. But having said that, the success of pass-through certificate, which is also known as PTC, is completely dependent on the pool, number one. Number two, very important thing in the pass-through certificate is the SPV, special purpose vehicle. Many a times, these companies who are having asset-based student loan, car loan, credit card loan, this, that, they make a special purpose vehicle. And why do they make special purpose vehicle? They make special purpose vehicle because they wanted to have a bankruptcy proof vehicle. I'm not entering into the technical meaning of bankruptcy proof, but just a layman understanding is that bankruptcy proof means that a big corporate having 20 entities. And in these 20 entities, one entity is doing the business of lending and borrowing. And when this one entity doing the business of lending and borrowing, then this entity is creating SPV, which is called special purpose vehicle. And in this special purpose vehicle, this entity is making sure that if this special purpose vehicle went bankrupt, then it won't affect or impact the financial situation of the whole group. By the way, this is one of the tactful reason behind the special purpose vehicle, because one of the reasons behind special purpose vehicle is to make sure that the whole group, the whole corporate entity remains in place or intact. God forbid if there are delinquencies in the underlying which are held by the special purpose vehicle. Henceforth, the investors needs to understand very clearly that the bankruptcy remote needs to check. And ladies and gentlemen, when I speak about bankruptcy report, I do not mean that only a word is suffice. Please take a note. I do not mean that only a word is suffice. What I mean to say is that you need to enter into the agreement. Agreement means when you are investing in PTC, which is called pass-through certificates, you get an agreement from the relevant party. Could be bank, could be financial institution, or any other player. And this agreement, also known as definitive agreement shortly, this agreement needs to be signed and vet by you. If you are signing this agreement, it means that you are obligating yourself to honor this agreement, which means that once you are investing in pass-through certificates, then this obligation is something which you can't run away any court of law. Henceforth, read this definitive agreement very, very carefully. Please take a note of that. Please take a note of that. Next very important thing is called skin in the game. Now, skin in the game means that many regulators in India or across the globe, they make something mandatory which is called skin in the game. Just like if we speak about the Securitization Act 2002, which is, by the way, one of the finest acts I ever been to. In this Securitization Act, there is a concept called 15:85, which means that if any ARC, asset reconstruction company, buying anything from secured creditor, then 15% of the funding to be paid upfront from your pocket. And rest 85%, the balance, can be converted into small pieces, which is called SR, security receipt. Similarly, this concept is technically known as skin in the game. The similar concept we are having in the pass-through certificate also, which means that the originator entity need to invest some money in the issuance of pass-through certificates. So let me give you a simple example. Ramlal Chole Bhature, my favorite example. In this suppose Ramlal Chole Bhature is a bank, assuming that bank is having a pool of 20,000 crores. And that pool they wanted to free. So they create SPV, special purpose vehicle. And in this special purpose vehicle, what they did is that there is a skin in the game, which means assuming 15%. Please take a note, assuming. Out of 20,000 crores into 15%, which is roughly 3,000 crores, that 3,000 crores to be invested by Ramlal Chole Bhature. Which means if tomorrow there is an issue with that asset class, then Ramlal Chole Bhature money would also went bankrupt. Remember, the name Ramlal Chole Bhature is simply an example. God forbid if this ends up as a coincidence, then it's purely a coincidence. Investors needs to learn that skin in the game is very much mandatory. But unfortunately, sometimes people do not have a technical understanding. And once they do not have technical understanding, they end up not reading this, what is skin in the game. So please note that skin in the game is very much mandatory. Ladies and gentlemen, there is a thing called NIM. NIM means net interest margin. There are few people who call this EIS, which is excess interest spread. Now, technically speaking, net interest margin and excess interest spread, EIS, both are more or less same. Having said that, net interest margin is used normally, while EIS as a concept is used when we talk about securitization market. In EIS, excess interest spread, we see that if the originator is making average interest, actually there are two parameters in that. One is known as average interest and one is known as weighted average interest. Unfortunately, many people feel that both are same, but I technically feel that both are different, because when we speak about PTC, which is called pass-through certificates, in this eventuality, we need to learn that both are not same. EIS is used in securitization purpose, while net interest margin is used in normal banking parlance. So when we speak about EIS, assuming like the example which we made earlier, Ramlal Chole Bhature is the originator and the pool which Ramlal Chole Bhature is holding, that pool is generating a return of 18%, assuming 18%. And that pool, which is generating a return of 18%, on that pool, they wanted to have the PTC, which is pass-through certificates. And suppose they prefer to offer 10% return to the investors. Now, that 10% return which they are offering, 18% but they are getting, that 8% is the excess income spread. Ladies and gentlemen, there is also one big issue when we are having excess income spread. And that big issue is the issue of hedging. I am just highlighting here, but I am not going to be deliberating much on that, which is what would if the originator is receiving the floating interest rate, whatever the floating benchmark of that country, and they are passing the fixed interest rate. It means you are receiving the floating, but you are passing the fixed. In this eventuality, you are taking the basis risk, and that can only be hedged using OIS, which is called overnight index swaps. I repeat, overnight index swaps. Unfortunately, the people are not very familiar with that. There are many jurisdictions where overnight index swaps are not very prevalent. People do not know much about that. The liquidity is an issue, and so on and so forth. Henceforth, when we talk about EIS, which is called excess income spread, which is very often term used in securitization, the very first thing the investor need to understand is whether it is fixed to float or float to fixed or float to float. I repeat, whether it is fixed to float, float to fixed, or float to float. Last but not the least, the credit ratings. I don't want to talk much about the credit rating because effective 2008, ample has been said about the credit rating. Ample has been said about the credit rating. But one thing which I wanted to tell is that relevant pool is already rated. And that rating is dependent on the probability of a model which is adopted by that credit rating company. Effective 2008, much has been said about the credit rating, the work culture of the credit rating. In fact, one of the Hollywood movies which I watched on Amazon Prime, because I'm a member of Amazon Prime. In that Hollywood movies also, one of the credit rating agency person made a blunt statement. I don't want to mention the name of the movie, so you understood each and everything. I just want to tell you one thing, that pass-through certificates can be buy from bank, even a non-banking financial corporation can buy that. Sometimes corporates can buy time, retail investors can buy that, and many a times even sovereign wealth funds or other people also buying that. But having said that, that completely dependent on jurisdiction to jurisdiction. Henceforth, if you are an investor in pass-through certificates, and of course, this is not the only video about that, more videos to come. If you are an investor in pass-through certificate, something which you need to understand is that how exactly the mechanism behind that pass-through certificate is working. And this is very essential. This is very important. Let me tell you. Many a times, the investors of the pass-through certificates are from offshore entities. They are from the host jurisdictions. Sometimes they are trust. Sometimes they are, asset reconstruction companies. When I speak about asset reconstruction companies, I mean to say, as the global definition is concerned. The very important thing which I always say as far as the pass-through certificate is concerned is definitely the number one, the collateral, the quality of the collateral, no doubt about that. Number two, the skin in the game. And to me, the skin in the game should be higher, higher, and higher. Third should be the credit rating. These are the three important things which I consider if I'm asked to invest in pass-through certificate. But having said that, one thing that I want to tell you, that if you open Google and see that the volume in the pass-through certificate has grown over the period of the time. Every credit rating agency have their own methodology to price or value pass-through certificate. So it is essential for all investors to download the copy of that rating methodology, to understand that, to understand the pool, to understand the redemption, to understand the average maturity, and last but not the least, to understand the impact of the rising interest rates, which I said it could be fixed to float, it could be float to fixed, it could be float to float. And the most dangerous is fixed to float. Most dangerous, because in this eventuality, if the interest rate continue to rise the way it is rising right now, the whole pool can be devastated. The whole pool can be devastated. This is Rahul Magan from Treasury Consulting Group. You have my number 9899242978. Ladies and gentlemen, this is an introductory video. As soon as we are finding the time, we would have more videos about pass-through certificate. Thank you.